This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Welcome to the Wealth Roundup for the week of February 13th. I'm Terry Evans, along with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Well, Patrick, since we last spoke, it's been a pretty volatile week on the markets, has it not?
It has, and kind of a continuing theme, say, over the last 3 weeks. You know, it was really only, I'm trying to keep track now, but I want to say 2 or 3 weeks ago that, you know, gold and silver went through this huge shock. You know, I think gold dropped, somewhere between $600 and almost $1,000 an ounce temporarily. So yeah, you know, when we look at the markets today, you know, when we look at the net, you know, the U.S. market basically flat for the week. If we just look at the S&P 500, the TSX up about 2% since our last podcast. Now that probably a little bit exaggerated because prior to last week's podcast, we'd actually seen the TSX take a dip on those very same precious metal declines from the previous week. So a bit of a recovery in precious metals. So TSX is kind of finding some more stability. WTI oil prices kind of firming up around 64. Unfortunately, the differential with Western Canadian Select has widened. So we have about an $18 US difference right now. So supply glut in heavy crude and you know, perhaps a little bit of a change in the narrative. I had, you know, probably come out and said we didn't really expect much of a change due to the events in Venezuela, at least in the short term. But it is actually appearing like the amount of Venezuelan heavy oil showing up on a daily basis, primarily from Chevron, has increased quite significantly, almost 300,000 barrels a day more than what we had seen coming out of December. So the ability to ramp up much more than that, we'll have to see, but that certainly is a bit of a surprise. Gold prices today, well over $5,000 US an ounce. You know, Bitcoin down another 4% since last week, around 70,000. So there would be, you know, quite a bit of volatility there for sure.
In the media, in journalism, newspaper and television primarily, but it also happens in radio. There's an old adage, an old saying, if it bleeds, it leads.
Yes.
That's talking about, you know, maybe sensationalized headlines, but we have to, as investors, be careful about these kinds of things and not knee-jerk reaction and that sort of stuff. Is that fair to say?
We do. You know, it's you got to sell ad space, and that's what kind of allows the media to keep us informed. So it's kind of the horse and the cart type thing, and sensationalism definitely attracts more eyes. It attracts more clicks. And so I think it really is kind of important to kind of put some context and kind of do a deeper dive. You know, we've been talking quite a bit about Mag 7 earnings. Last week, we still have one more to go at the end of the month, NVIDIA, but we've had the other 6 come through. You know, for the most part, if we take a look, is that the results, you know, we're still kind of early days for all of the U.S. earnings, but the average increase in earnings from the fourth quarter is up about 11%. So kind of right in where our expectations are. But we've seen some other notable declines that I think did catch the headlines quite a bit. So software, you know, was under pressure. And I would definitely throw Microsoft, you know, being probably the biggest software company in the world and one of the Mag 7 stocks. And we look at Salesforce, Microsoft, Adobe, all really well-known software companies, and all having their stock prices down close to 20% if we look over the last 2 weeks. But if we then go and look at the markets and say, the markets are relatively flat. So we really can't call this a wipeout in the markets if the markets are trading at about the same level that they were a week ago. So really important to kind of do that exercise, and then going and saying, you know, so why in fact are those software stocks down? We probably have had some headlines about AI, that it's just a passing fad. Really, you know, I think what we were seeing play out in software last week is that software companies make their revenues on selling software solutions largely to businesses. And if AI, the expected outcome of AI is going to be a productivity bump, what maybe took 10 workers before to perform a task might only take 7 if AI kind of lives up to its expectations. And so that would mean potentially 30% less subscriptions for things like Adobe and Microsoft Office with Copilot. And so really what we're seeing is this AI story kind of percolating through the capital markets. And much like we had talked about in our December 17th podcast, is we had indicated there was going to be some disruptions due to earnings and companies giving us some forward-looking guidance. And I think this story will kind of continue on, is that as AI kind of percolates through the system and has to get monetized, is we're going to have to see whether or not these businesses can pass on those expenses to the market, and then obviously businesses maybe resizing their labor force. And I think that's kind of another big thing in the headlines, is that U.S. unemployment, so those kind of looking for work in the U.S., that number increased, but labor participation in the U.S. has actually dropped. And there's probably a variety of reasons why there's less people looking for work. You could say it's in around immigration. You could also say that it's in around demographics. But if you have less people looking for work, but you have more people maybe out filing for unemployment, is that we're actually seeing the unemployment rate not changing as much as perhaps the headlines would suggest. So again, we had kind of talked about this idea of the psychology of investing and fact checking the results. And I think all those things are kind of tied together with those media headlines.
With the Mag 7, that group or that fund, I don't know if they're all in the same fund, with them dropping in the neighborhood of 20%, some of them, does it have people like day traders or investors licking their chops sort of thing, thinking that, oh, well, it dropped that much, let's buy low and hope that it goes back up? Or I guess everything's a risk, though, but some people would look at it as an opportunity. No?
Yeah, no, I think so. So the Mag 7 would be these 7 kind of tech heavy stocks. So Nvidia, Apple, Microsoft, Alphabet, Amazon, Netflix, Tesla. You could actually trade all 7 of those by buying an ETF that just buys you the Mag 7. I think the symbol for it is called MAGS. Or you can actually even find ETFs that buy you everything but the Mag 7 on the US market. But yes, to your point, you would see lots of commentary out there to say, have these stocks become more attractive at this price, specifically with, say, a really large business, very diversified business like Microsoft. We talked about this in the last podcast, is that their earnings are still incredibly strong. Stock price down due to some guidance that they provided out over the year. So analysts would certainly take a look at it and say, I really like Microsoft, and if we liked it before and now it's 20% cheaper. It's funny. I saw this great cartoon. It was kind of like one of those old Ziggy type cartoons that had two people out selling Bitcoin, and one was selling Bitcoin for $125 a coin, and one was selling Bitcoin for $70,000 a Bitcoin. And the lineup in front of the guy that was selling it for 125,000 was around the corner, whereas at 70,000, nobody was at this guy's stand. And very much about this psychology of investing. How people operate. You would think that when things get cheaper, is that people would be more excited about buying them. Maybe not follow through with Bitcoin. We still don't know what Bitcoin's going to be one day. But a business like Microsoft, which we know is going to be around for a long term, I would say yes, absolutely.
We're about the anniversary of the tariff talk that started up a year ago. This is when all the threats were coming to fruition, and now here we are. We've got people saying that there should be more tariffs, and other people saying there should be zero tariffs between the U.S. and Canada in particular. Where do we sit now, 1 year in?
So interesting, and it's still, I think, really early days. But if we look at the trade surplus just on goods between Canada and the United States, is that Canada used to run a pretty healthy trade surplus to the United States, kind of averaging around $9 billion a month. And we have seen that trade surplus certainly narrow. And that was one of the goals of the U.S., was to kind of balance out its trade in goods with other countries, kind of move it more towards net zero, more in balance. And so we have seen the net exports to the United States has dropped. We're now in that range of about $5 billion a month, so pretty sizable. Most notably in autos, so auto exports. And the main reason for that is that most of the autos that we manufacture in Canada are designed for the U.S. market. And so with those additional tariffs, those vehicles are more expensive. So there's less of those vehicles are being produced. So we got about a 12% decline. And really tough to pivot on autos because it's not like we can go and send those minivans to Europe. Those minivans are designed for the U.S. market. If we look at steel and aluminum, they would be the next two sectors most highly impacted by tariffs. Steel exports to the U.S. down about 45%, so pretty significant. Aluminum, not so much, only down about 12%. So, what do we think is going to happen there? Well, we actually have already seen Canada's net exports to non-U.S. Destinations has actually increased. Now, really early days on that, but over the last couple months, we've seen that increase rise to about $8 billion a month. So if we take a look at that, certainly aluminum would be participating in that. And Canadian aluminum actually competes really well versus Chinese aluminum when we export it into Europe, because so much of Canadian aluminum is produced using hydroelectricity, which actually qualifies for some attractive carbon pricing on aluminum as it's being sold into Europe. So a natural kind of new market. Steel, a little bit more difficult, primarily due to its weight, to change the supply chain in terms of where it's shipping. So, we expect to be able to find some new customers for Canadian steel, but that's taking more time. But I think another really interesting way to look at these tariffs is to look at the amount of tariffs the U.S. is collecting incrementally more today as compared to a year ago. And so if we use this number that the U.S. has collected approximately $280 billion in tariffs globally since they initiated this new tariff program, about 18 billion of that has been collected from Canada. And so if we look at what we export into the U.S. and kind of divide that $18 billion back to see what the effective dividend rate is it's an increase of about 6.4% in actual increase in tariffs represented as a percentage of the goods we export into the United States. So when we hear some of the numbers in terms of the percentages, I think it's just natural for people to say, how are we going to recover from this? How are we going to diversify from this? Again, early days, but perhaps, that percentage isn't as high as we thought. It does put a lot of importance, though, on what happens with the renegotiation of the U.S.-Mexico-Canadian trade agreement, which, again, as we said before, will start in the spring, but could go on for a very long time and probably will be contentious. So I think that the positive to take from that is the diversifying of markets that we've seen. Right now, it's been most notably in oil, gold, platinum, silver. Whether or not that will continue. Obviously, with central bank buying of gold's been very attractive. Will that be the same case, say, 2 years, 3 years, 4 years down the road? So, is that something that is a fundamental long-term shift? I don't know, but certainly something to build off of.
All right, very good. For wealth management and to start your investment journey, find Patrick's contact information at www.patrickmleonard.com. If you're watching this on YouTube, please subscribe, like, and leave a comment below. And that wraps up the Wealth Roundup for the week of February 13th with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns.
Great week, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.